Thank you. A very quick round of introductions to my panelists who have done, there's been a lot of musical chairs since the morning on my panel. So I hope what you have on your schedules are somewhat reflective of who we have. But I'm very, very happy to introduce to you a set of investors who have very deep investments and insights into consumer, especially food and agri and food and beverages. On my right, we have Prabir Talati of Actis. They are one of the largest consumer investors across Europe, UK, Africa, and India. I think and they've been very successful in some of their investments in Asia, including in Mengniu Dairy in China. They were investors in Nilgiri Foods. They've had a very marquee exit in Paris, of course not in food, but that's a small snapshot of what Prabir and his team have done. Rakesh Soni is a veteran in the food and agri investment space. He currently is with Black River Proterra Advisors today, which is a pure food and agri investment fund. Prior to this, he was with Motilal Oswal and has had some really stellar investments in companies such as Mrs. Bector's and Parag Milk Foods. On his right is Aditya Joshi from Apex Partners, a very large buyout fund who like to invest about $100 million or more in large companies to really take it to the next level. They've had a phenomenal exit in their Israeli dairy company food called Tunuva, and I hope to hear more about that. On his right is Vinod Giri. He's from IDFC. IDFC Private Equity, again, have had deep investments across sectors in food and agri, including the very successful Parag Dairy, Parag Milk Foods, who we are all aware of. And last but not least is Srini Vudayagiri of People Advisors, one of the most successful packaged and processed foods investors, very interesting model of doing buyouts in mid-size and early-stage companies, and they have a very formidable portfolio of companies like Unibic, Sumeru, Shrestha, and sorry, what was Mayaz, of course. Mr. Mayaz will be here on our next panel. So I think with that, I will put my first question to all of you in probably the same order. Maybe start with Srini. Where do you see you've been most successful in finding the right kind of packaged food investments? Where do you see the F&B deal flow coming from? What are the new trends you see? What are the themes and sectors that you see most of the pipe coming through?
Yeah, thanks for that introduction. Maybe a couple of quick additions to what Nandini mentioned. We at People Capital have been invested in Indian consumption thesis for the last 2 decades, close to 2 decades. And specifically in food and agri, specifically in food and beverages, I would say more than agri, have been a very active investors. Some of the names what Nandini mentioned, beyond that, including the food services space. I think the trends, what we specifically are seeing now is, if I look back, what has happened in the larger thesis, one has gone from being made at home to a ready-made, to a package, to a branded play. And we're seeing the trends continuing in terms of playing through that. And the regional brands, which are becoming very, very important. I think one who was suggesting before to be relevant in the national markets, I think today one is seeing the relevance in terms of going across and working with brands which are relevant. Goes back to the niche segment, which keeps saying that India is combination of multiple countries in one way. We're also seeing a huge amount of the benefit coming through in terms of the focus on the health and the premiumization. Today, across our portfolio in the companies and the new opportunities, what we are seeing, there is a very large focus and an attention in terms of getting the health-oriented food products and the consciousness in terms of premiumization and the customization.
Just to add to where sort of carrying on from where Srini left, I think specifically on the packaged food, if you look at over the last decade or so, one thing that has really helped packaged food is the whole emergence of e-commerce and modern trade. So if you're focusing on certain niche categories, right, you're catering to the top maybe 10, 15 cities of the country. And if you look at share of modern trade per se in this top 10, 15 countries, though an overall India level numbers are maybe early sort of 2-3%, but if you do a focus study on the 10-15 cities, this number would be closer to 10%. So I think both e-commerce and modern trade has been sort of a great boon for innovative food companies. The whole challenge in terms of building up a comprehensive supply chain and sort of building up a distribution network has sort of receded a bit because of availability of these two channels. So I think that's one big sort of factor at play, and I see that sort of growing forward increasingly. So that's one trend. In terms of specific sectors, of course, we have seen a lot of action on the dairy side and dairy and ancillaries. In terms of where we see the next level of action, I think there is enough scope for some action on the bakery side. So we have seen few niche bakery players catering to the premium segment, but I think there is an opportunity to develop a brand across the mass segment, and I think that is something that looks interesting at this point in time. Snacks is getting competitive. I think there's enough players there, and it's difficult to sort of come up with a new brand and establish a decent market share there. So I think big picture, I think bakery is something that we are excited about. And of course, just to add to it, I think on the health and nutrition side, again, there are various people trying various products. It's more in terms of what scale they can achieve in the immediate 3 to 5 years. But if you look at it from a longer term perspective, I think that's the way to play it out. So if you have a holding period of maybe 7 to 10 years, I think that's again an interesting segment to look at. Thank you.
The one thing that Nandini forgot to mention in my intro is I'm a big foodie. So you can't cover food and agri without being a foodie yourself. I've seen my family business grow. So my family business is in food and agri as well. I've seen it grow and scale up as I've sort of grown up with that business. I represent Apex. We are a very large buyout fund, $46 billion under management. We only focus on 4 sectors, and retail, consumer, food, beverage is a very large portion of what we do globally. We haven't done a deal as yet in India, but it's not for the want of trying. But the themes we like in India and globally are, some of them have already been mentioned. Dairy. We've been large owners of dairy assets globally, including Tunuva, the asset Nandini mentioned in Israel. It's a deal we created over a 10, 12-year period, and we'll talk a little bit more about how we did that deal and how we're trying to find those deals in India. We love bakery. We've done Panrico in Spain, the largest bakery business out of Europe. Opportunities there in India. We love QSR. We used to be owners of Johnny Rockets back in the day and scaled that business extremely well in the US and exited 10x MOIC or 12x MOIC. We love cafes. We used to own Tijuana, which we sold to Starbucks. So if you go to Starbucks today and buy the Tijuana tea, that used to be part of our portfolio. And then we love restaurants. We own Golden Dragon in China. It's a very large buffet chain. So we like all these themes in India, just that our check size threshold is 100 million, 150 million. So we haven't been able to find deals in that check size yet in India, but we have tried, and we came very close to investing a very large dairy back in 2014. That would have been a sizable check for us. But we're pretty excited. I think it's a start of a journey for us. Food and agri is in a nascent stage in terms of buyout funds. So we'll see deals come through in the next 10, 12 years. And we're pretty hopeful. Thank you.
Thanks, Nandini. Just to give you a quick background of Proterra. Proterra was known as Black River till last year. From this year, 1st of January, we became Proterra. It's a global fund which only invests in food and agri across emerging markets. We manage close to about $2.2 billion. Talking about the packaged food, I personally have a little different take on that. If you look at the entire packaged food industry in India, it is zilch. If you compare as a percentage of the entire food basket that we see. Even if you look at the P investment that has happened in this country in the last 5 years, close to about $3.3 billion has been invested. And out of that, not even 10% has gone to packaged food. Bulk of the investment has gone into restaurants, dairy, and other front-end businesses. The point that I'm trying to make here is packaged food itself will take a lot of time to attain a size which will attract attention from any of the investors like us. You will always find smaller deals in juices, in niche health products, but to be able to invest large ticket sizes like what Aditya mentioned, you need scale, and which is not there as of now. So what I would say is that there will be a lot of shift that will happen in the large commodity food businesses. Dairy, case in point, if you see last 5 years, that was the first time when private equity investment went into dairy, and now we see so much more investment coming into it, including PE and M&A as well. So if you look at the opportunities, I think the opportunity lies in large commodity food businesses. Staples could be one. Staples is a 1.2 lakh crore industry, and the largest player in that industry is less than 10,000 crore. So there has to be a lot of consolidation that's going to happen in that place. Maybe your staples will now become a packaged commodity. So packaged food, in my eyes and ears, would just not be niche products, but it would be large commodity products as well.
I am Prabir from Actis. And Actis is a fund that's very interested in investing in consumer. Globally, we're about $7 billion in assets under management. And we've invested about $1.5 billion in the consumer space. It's one of our core sectors. And that ranges across categories from food and beverages, includes dairy, includes packaged foods, to restaurants. We had an investment in China, in Egypt, in Nigeria. So we've invested in markets across Africa, China, Brazil, in these sectors. In India, while we invest in home and personal care, we haven't yet invested in the food and beverages space, not for lack of trying. A big challenge has been investment size. The sector has been nascent, it's been growing. I think we'll get to see a number of opportunities in the next few years that will be at the scale at which we look to invest. So we typically cut out a minimum check of $75 million, go down to 50. In the food and beverage space, given our level of interest, we've actually taken that down to 25 and said, let's see if we can do things differently. So 10 years ago, I partnered with an entrepreneur in residence. We actually got a CEO from the food industry. And we said, let's go and buy something. Let's invest a minimum of $25 million and buy one platform. And then let's grow it. 5 years ago, I retained an investment bank to cover the country, look at investment opportunities, and again try and build something again, saying, all right, let's start at $25 million. So we've made various efforts. And what we also tried to do was say about 3 or 4 years ago, was work with a search firm and say, we'll retain you, show us, let's meet talent across the country, managerial talent, who are prepared to step out, and together we'll work with them to buy something. So we've made these efforts. I think deal size has been a constraint, pricing has been a constraint, but we're hopeful we'll get there as the sector grows, because the sector is fast growing. There are structural shifts in the industry, as Srini talked about, and I think over the next few years, we hope to get there.
Thanks. I think that was a very interesting insight into each of your outlook, and just to stay with that point of Prabir's, which is why is ticket size a constraint? What is going on between the pipeline as deals come through, VCs to growth PEs, and then somewhere the buyout funds are not able to see enough deals of their kind of size? And I want to probably go down that pipe to each of you in a particular order of size to see why is the pipeline leaking? Are there good reasons? Are there bad reasons? And there are many in the audience. I think we have many mid-size and young companies who would probably want to hear what is it that you need to do to, get to the right scale? So I'll start with Srini again. Let's look at where is your deal pipe coming through? Are you seeing more VC deals that you've had quite a few situations where you've taken a venture-east company or an asset capital company, and you've been very successful in being the Series B round, except that you've taken it to the other extreme to say, I'm going to own controlling stakes in this company. And I will follow through with Vinod and Rakesh in that order to again see, early stage. Rakesh has been with Motilal, and then, in a bigger platform, and IDC's invested in some of those Series B. And then I'll finally come back to Apax and Actis on Series C to see, what are the reasons for deals to sort of fall off that cliff. So Srini, with you again.
Yeah. I think as a growth stage investor with some focus on financial majority, the so-called buyout, we do see fair mix of investment coming through both in terms of early VC funded companies, and interesting, some of them have built the initial stage, initial platform, initial foundation. Some of the examples, what you mentioned. I think we're also actively going across and seeing first-time professional turned entrepreneurs who have started those businesses. We have some fantastic examples, part of our portfolio. Nikhil is here. He's going to share his thoughts in the next panel. But I think it's a fair mix. I think it's a very situation dependent. But given our mandate, where we are critically looking at in terms of creating India's specific branded company spaces, what do we look at that when we are going across and creating that? I think our philosophy has been in 3 counts. Is there a credible brand which has a good connect with the consumption space? Is there a distribution channel which is being built, which can be utilized in terms of putting in the relevant product over a period of time? And is there a differential product offering in terms of new product development, the quality and the differentiation which can sustain itself over a period of time? I think the problem what one is seeing, if so, in terms of some of these companies not being relevant on the larger scale, have been many of the food, especially in so-called packaged food companies in India, have been family-run companies. Traditionally, family-run companies, quite a few of them, what we can go down the path in terms of naming, be it in Haldiram in the north, to a Saravana Bhavan in the south, to a Archie or a Priya. Question is, are these companies willing to take a private equity or a venture capital sort of a funding and allow the funds to work with them to create a credible exit phenomena? So that can be an hindrance in terms of for the larger funds, unless otherwise there clearly been a transition out happening at the promoter level, at the family level. But at the growth concept level, I think that has been one hindrance. So the way we gone about is identifying some of these companies fairly early in the journey. When I say early, some of these companies have been as small as even single-digit crores, single-digit millions of dollars. Go across, create a long-term plan of creating those 3 or 4 differentiating concept, what I mentioned about, and work with them to make that happen. I think that's what worked for us.
Right. So Vinod and Rakesh, what are you seeing? Where do you find your most deals coming through the pipe?
Sure. So if I look at specifically from our context, we are typical minority investors. We have done controlled transactions, but not on the food and agri side per se. So our approach has been to sort of approach more of minority and growth capital sort of investments rather than control sort of investments. And I think a lot is actually goes back to the point that Rakesh made. If you look at packaged foods as a category per se, it's still a very young industry, right? So if you look at the deal flow, and in fact, if you look at the last 5 years, the quantum of deal flow in early stage has increased significantly. If you could have looked at a period, maybe from a period between 2000 to 2007, 2008, we hardly saw any sort of, initial or early stage deals on the packaged food side. I think that is one thing that is happening very recently. It's a recent phenomena. So most of the companies that you sort of look at or who have created a decent brand or a decent supply chain sort of a network are pretty young stories. They would be maybe 5 to 10 years sort of a story as such. So I think it's still in a very evolutionary phase. So that is the reason you see a lot of transactions on the early stage side. And the funnel actually tapers down when you actually come to a growth in control transaction. And the reasons for that are pretty obvious. I think on the consumer side, the beauty of the business is such that these are typically high ROE, ROC, good cash generating sort of businesses. So people who have done a good job may not require really external capital unless and until they are looking at significant expansion beyond the few geographies that they are strong at, or the business requires investment into capex, right? If you have sort of done your model right, and if you are in sectors where you can get it co-packed, again the investment requirement is not there. So I think it's more in terms of where the industry is today, and if you look at data in terms of the control transactions that have happened in the country, very few, right? Maybe one in dairy and very few in terms of control. When I say control, it's more in terms of a strategic or a large sort of PE fund doing a control, doing a complete buyout. So I think it's still early days for us as far as packaged food in India is concerned. Surely the funnel or the deal flow will increase over the next 5 to 10 years, both in terms of growth capital as well as control transactions.
Thanks, Vinod. Rakesh, I think we've seen Proterra starting to do a lot of greenfield, bottom-up sort of build-outs. What's your thesis behind that? That's quite refreshing and I think interesting for a lot of people here.
Yeah, I'll speak about that, but just before that, I'd like to mention a couple of key points here. In the last 5 years, there have been 199 transactions in the food and agri space, which includes the larger food space. I would also include the food logistics in this, including agrochemicals. Out of this 199 transactions, only 11 transactions are more than $50 million. So sorry guys, food and agri is not for you. So only 11 transactions last 5 years. Out of that, 2 has been large buyout. One is NCML by Fairfax and the other one is by Temasek in Godrej Agrovet. Both of them are not technically food. So if you take that out, then you are left with 9 transactions and the total investment will be less than $500 million. Then if you look at the segment which is $25 to $50 million, there are 37 transactions. If you go down further, there are 26 transactions in $10 to $25 million and there are 125 transactions in less than $10 million. So if you look at that number, and I'm telling you this number because we just had an offsite and we did this entire analysis and hence I'm remembering these numbers. So if you look at the food and agri space in India, it's all about sub $10 million. So people like Srini, who actually identifies the sector and kind of invest in early stage, is I think the model to go in this country. You can't invest large amount of checks in the food space as of now. And hence, the whole concept of investing in commodities come into picture. Because if you want to invest in food, packaged food industry, you have to put in small checks. And I don't know how many deals you can do through one fund. So that was my one point. Secondly, what are the sector, how do you look at, and what are the opportunities that you find? So if you look at our fund, globally what we have done, we have kind of broken our investment thesis into 3 parts. So one is protein production. This is essentially going and setting up large production bases, which includes farms, which includes factories. Now that's a difficult task in India. In China, where we have invested close to 60% of our investment, we have built one of the largest dairy farms there, where we have close to 80,000 animals of our own. We have built hog farms, we have built duck farms. But if you have to do that in India, you can't do, because you can't acquire land of that scale and size in India. It's very difficult you can't import animals in India, hence you can't do that as well. So what do you do? The question is, what do you do in a period of 5 to 6 years where you could put your money and take it out and also make a multiple on it, which has to be currency adjusted. So you've got 3-4 challenges, in front of you. One is you have to invest a large amount of money. You have to also get that money out of the investment, and top of that you have to make returns which is currency adjusted, which means that you have to generate a return of close to 25% on your investment year on year, whereas that particular investment on itself makes an ROI of less than 15%. Now if an investment that makes an ROI of less than 15% and you are expected to generate a return of 25%, the math doesn't work, and hence those investments are not happening. So it is as simple as that. Everybody is very excited to invest in that space, but the moment they make a model and the model is presented to their ICs, it gets rejected. So the question is, where do we go? So if you think about it, I think the way to go is, one, we need to find more processing facilities which are of world class, because India on an overall basis needs a lot of efficiency, the kind of efficiencies that we have. Even if you compare dairy today, I mean, the average yield of cow globally is between 25 to 30 liters a day. In India, we are like less than 10 liters. Can we do something there? I think a lot of investment needs to go to make our existing operations more efficient. I think that's the way one can look at. Secondly, if you want to do larger transactions, there has to be consolidation. We are way too regional. If you look at go to any region, and it's in India, Calcutta will have its own, let's say a dairy player. South, you will have its own dairy player, or for that matter, a staple player. You have a Rajdhani in Delhi, you have a Ganesh in Calcutta, you have Parak in Bombay. So you have a lot of regional players in each and every place. There has to be a way where we can bring them on one platform. And I think that would need a lot of capital. So my take would be that there has to be consolidation. There has to be more processing facilities which should enhance the efficiencies. And I think people like Srini will have a ball time because a lot of more and more people would be, raising capital which is less than $10 million.
Thanks, Rakesh. I think that's very comprehensive. And on that consolidation point, I'll go back to Prabir. And I know Actis has been working very hard to try and find a platform and then to bolt on. There have been one or two out there, investments, and one of them again is on the next panel, which is Global Consumer, probably similar, conceptualized similarly by Goldman, to start with a platform, back a professional, and then sort of add brands or bolt on brands. But it takes time. Why do you think what are the challenges you've seen? You've brought down your ticket size considerably all the way down to 25, and yet you're struggling for this theme, for this sector. Yeah.
So, I mean, let me flip it a little bit by first talking about what it takes to sell a business, right? I mean, we celebrated, Actis celebrated its 50th exit in India with the, $1 billion endurance IPO that we just exited last week. And I've done 12 of those exits. And when you're selling a company, there's someone buying at the other end. So if I'm buying, someone selling at the other end, right? And there's a few things to keep in mind when you're asking for what is it you want from a buyer. So we see, in many cases, we see young companies growing well. There's clearly an exciting future for the space. Structurally, it's growing really well. But we see young companies growing well, but they're benchmarking themselves with companies that are significantly larger and more fully formed, mature companies. The management teams are not as fully formed. Many segments in the consumer sector, particularly in the food sector, are not represented in public markets. So, companies that are at an earlier stage of their life cycle can go public a lot easier. Our challenge is that there is a host of capital choices available. It's good for businesses. We don't pretend to be the cheapest form of capital. Equity is expensive. But, different flavors of equity come with different costs of capital. Private equity tends to be the most expensive cost of capital because we're investing in illiquid businesses. And, therefore, companies have choice. Companies have options to go to lower cost of capital and very often choose to do so. And that's all right, So where do we see ourselves playing? We typically, and this is not just food and beverages, but in the consumer space, good businesses performing well are typically not going to need capital. And therefore, where we come in is a capital structure event. And what do I mean by that? There's either a company wants to buy another company, so they need money, or there is a shareholder event in this form of a shareholder wanting to sell. And that's why even smaller businesses then become large enough from a total value and give us that opportunity. So we typically we're not into market creation because the amount of check size is too small, the time frame is too long. But these are areas where we think we can operate. But these are the challenges we face. Companies have a lot of choice. They're exercising it. None of my competitors sitting here, there are all the stock exchanges out there. Those are our real competitors. They've always been, in my opinion.
Thanks, Prabir. I'll come to the big exit and valuation discussion a little later, but I want you, Aditya, you mentioned about how Tunuva took about 10 years or more to build out, and probably there are very few funds of that vintage who have been, or even if funds have been there at that vintage, I don't think companies of that vintage, unlike a Godrej, who are very rare, or a Parley, which will probably never take a private equity. Those are the kind of companies who've come up to that kind of scale. Therefore, I often hear that in food and agri, you need patient capital. You need funds to stay in there longer. Growth funds need to stay in longer than their typical 5-year horizon. They need to see 7 to 8 years to see the fruit of their labor, to see margins become positive, and then onward you pass on the baton to again another round of patient capital. And somewhere I find as a banker that sometimes the 4 to 5 year horizon is not sufficient for a lot of promoters to deliver that result. So what are your views? And
so I think we talked about it before the panel started. You asked me, why haven't buyout funds done so well in India in agri? And my answer to you was, picture abhi baki hai. Because we have taken 30 years as Apex globally to build the portfolio we have built and to make the return we have made. The Indian food agri business is still nascent. Check sizes are small. There will be consolidation. These brands will break out of their regional footprints, go national. They'll need our capital. So still next 10, 12 years, we'll check back in 10, 12 years in terms of what deals we have done. But to your point on deal sourcing, where do we see deals coming through? Thankfully, a lot of our work is done by our friends around here who go and pound the pavement, find the entrepreneur, back him. Sometimes deals don't work and then those companies go bust, but some of them do work, and then obviously for an exit, they come to us. So I'll give you an example in dairy, and I'm not talking about my own pipeline, but if you look at the space, the 5 or 6 large companies, Dodla has an investor in Black River, Creamline has an investor in Agrovet / Temasek, Tirumala had Carlyle, Parag had Motilal, IDFC. So they've done all the hard work, they've found the entrepreneur, they've found the management team, they've put in systems, they've turned the business around, they've gotten to an interesting scale for us, and then that's the time we come in. Tunuva is actually a very good example. So the deal it's an Israeli business, dairy, $2 billion top line. When we came in, it was owned by 120 farmer groups. And so we had to convince 120 farmer groups to create one entity, put all their stock in there, bring Apex in. We took 70% stake. At that time, they were doing only liquid milk. And over time, they sort of got into hard cheese, soft cheese, milk, dairy, beverage products, baby foods, and so on and so forth. And the business did extremely well. We finally sold it to China Bright Food. It was hard selling an Israeli company to a Chinese enterprise. But we made 6-7 times money over there. So, and it took 7, 8, 10 years for my partners in Israel to find the deal, cook it, do it, scale it, and then sell it. So it takes time. I'm pretty hopeful that over the next decade or so, we'll see interesting assets from hopefully the portfolios of folks sitting on this panel and elsewhere.
Thanks, Aditya. We have only about 10 more minutes, and I'd like to keep 5 minutes for audience questions. So, one very last quick round of questions on valuations and exits and what you compete with. What do the growth funds, what are their exit options? We've seen very few strategic exits, and one of them I still talk about is MTR Foods to Okla, and that is at least 7 or 8 years ago. And then the most recent one was really Lactalis, Tirumala. Most of the other funded assets have gone the IPO way. So, a quick round, probably a sentence each on, how you feel about that. Why do you believe IPO has been a better route for exits? Is valuations an issue? Is the ease of the process a determining factor? Are bankers like us, to take credit or blame for it? So Srini.
Valuation is a difficult thing, and I think it's to an extent, herd mentality, and few of us sitting on this dais may be culprits in terms of setting those benchmarks. So let me not get there. But I think it continues to be a challenge in the fact that any scaled-up businesses, either they are so self-sustaining they do not require external money, or anybody who else otherwise has built anything interesting in terms of the size and scale, valuation seems to be a little bit of a concern in terms of the exuberance continues to be there. I think, and that's one of the reasons what I go back and said that we followed a philosophy of identifying some of them very early and building and working with them over a period of time to scale them up. In the process, at least the exit process, what we found to be very, very useful has been more in terms of going across and giving it to folks like Aditya and Prabir in terms of larger PE funds, or going and talking to some of the strategics rather than going through the IPO market.
Thanks, Vinod.
Sure. So, of course, entry valuation is always a challenge if you look at it from an investor's perspective, and given that capital markets love these businesses, and there may not be sort of relevant benchmarks that are available, but of course, as a sector, there's a lot of love and affection that capital markets have for the consumer sector, and that plays out in private deals, be it early growth or controlled transactions. In terms of exit, I think it's a great sector because relative to other sectors, you have multiple exit options. IPOs, again, even if you have a sort of a mid to sort of a decent sized company, it's easy to get it listed. From an exit perspective, I think the key thing is, what is the entrepreneur thinking of? Is he sort of game for a controlled transaction? I think that is the key thing, and that determines the next course of action, whether it's an IPO or a sale to another financial investor. So I think that's the key. In terms of valuation, if I don't see a huge difference in terms of what you could potentially get from a strategic investor or what a public market could potentially give you. So it boils down to what is the intent of the entrepreneur. That's the key thing here. And just to highlight as a case study, I think both Motilal, Rakesh and ourselves invested into Parag, and that has been a great sort of an experience for both of us. So, Motilal came in mid of 2005, we came in 2012, we got it listed recently. And, during the period of our investment, both Motilal and us, given that the company was of a decent scale and size, we always had interest, be it from strategic, be it from other financial investors. So I think, and see, given that we have invested across sectors, this is one sector from an exit perspective that we have a high level of comfort. If you are able to scale it up to a decent level, I don't see a big challenge from an exit perspective.
So on capital markets specifically, with respect to food agri businesses, I think the capital markets in India are much more forgiving and much more lenient. They accept smaller companies, let's say even 150, 200 million top line, to go public, list. Typically, if you look at the more developed PE markets globally, you would see these companies owned by sponsors rather than by capital markets. So in India, sometimes these companies jump directly from growth funds to public market. They just sort of skip the buyout fund step altogether. Unfortunately, the deals we see are the ones that haven't been able to go to capital markets, which are lower ROCE, lower return, where you don't want to invest, and that says that we want to invest in higher ROCE, they don't need our capital. So it's a bit of a chicken and egg. Hopefully we'll crack and make some omelette at some point. But I do think, as Vinod rightly said, the markets are robust. You'll get good exits. And so Apex now has a dual strategy. We have just raised a $10 billion fund on the PE side. We also have a €1 billion public markets fund listed in London Stock Exchange, which takes small stakes in listed companies in India and globally. So we now have a $150 million book. I don't know whether you guys know that. In India, and a $1 billion book globally. So we will play this bit of the value creation as well.
I would like to answer this question a bit differently. I think exit is sheer luck. There is no plan, there is no strategy. Nobody can say I'll make so much of multiple when I invest, because in all our presentations we always show 3 to 4x, and it never happens. So I think we should talk about things that which are in our control. Now, what is in our control? In our control is to make robust companies. In our control is to make companies that are cash generative. In our control is the companies that can generate high ROIs. I think that's where people like us can contribute. Today, as we speak, the way the markets are, any company can go public, any company can make 3x, 4x, 5x for you. I can say it very confidently that the maximum amount of money that we made in our investment, actually at one stage we were writing it off. So there are external factors which determines your exit. It is not your internal factors that determines your exit actually. So I would say invest in businesses that end of the day generates cash. Cash is king. If you are generating cash, whether it's a good market or it's a bad market, you will always find a buyer. It could be a difference of degree, but it will not make a huge difference. And talking about exits in India, again, I'll put some data, courtesy my recent offsite. In last 5 years, we've done about $30 billion of exit, And out of the $67 billion that we have invested in this country in the last 5 years, I'm talking about PE, pure PE, we have exited $30 billion. Somewhere, and this amount is the amount which is OFS, which means that this is the money that has gone to the PE funds. It doesn't include the follow-on funding that the company would have raised in the process. So there have been fair amount of exits. But please understand that private equity as an asset class in this country is only 10-year-old. We are trying to write a verdict too soon, right? And in this 10 years, there have been 3-4 years which has been absolutely reckless. So we have to give enough time before we talk about exits. And if we build companies that are robust, which are of international standards, which are very efficient, we'll always find funds like Actis and Apex to buy it out from you. Because they will not look at the market. What they will look at is the company. What they will look at your ratios. They will look at your cash flow. And if you're lucky and if you have the public markets the way they are today, you can always go public. So that's my take on exit.
Yeah, Nandini, I have to say I agree with a lot of what Rakesh says. Can I just offer a couple of additional perspectives on this? In a bull market, private equity capital cannot compete. In any case, as I mentioned earlier, our cost of capital is higher than that of public markets. But there is another angle to this. If I think of private equity, and we are early in the journey in private equity in India, but if I think of private equity, for the entrepreneurs out there, private equity is about a spirit of partnership, right? And you go to a private equity fund, and a private equity fund comes to you when it's a partnership you want to form. So you treat us the way you treat a partner, and we want to treat you the way we treat a partner. If you want to carry on the journey alone, and by all means, this is not to say which one you should do. It depends on where you are at your stage of your life cycle, your stage of evolution, and your philosophy at that time. If you want to go it alone, take debt or go to the public markets. But if you're doing something that needs a partner, that's when private equity is right for you. So in other words, come to private equity when you're hungry and you want to eat. I thought that would be a good one to end.
Thanks, Prabir. I think that was excellent. With that, I think I have no more questions for the panel. I have spent many years, and probably over 2 decades, being grilled by these 5 gentlemen on many transactions. It's a real honor and a privilege and a treat to be able to turn the tables. I only got a chance to ask them 3 questions. Thank you very much, Srini, Vinod, Aditya, Rakesh, and Prabir. I hope you guys enjoyed the session as much as I did, and thank you very much.